American prosperity the last 40 years. Everyone wants to take credit for it. The politicians, the political parties, and of course, your financial advisor. But what if all this prosperity was just an illusion? What if there was no prosperity? For sure, there are technological advances, but what about the level of quality of life? Let's start with the family of 1970. Long before America Online, iPhones, and of course, President Clinton, the 1970 family was a one-income household, saving 11% of their income. By comparison, a generation later in 2006, our more prosperous-looking Americans has not just one income, but two. And this family was putting away nothing. Today, that number hovers around just 4%, which is 50% lower than the savings spike we briefly saw around 2008. Revolving debt as a percentage of annual income in 1970 was just 1.4% of a family's income. Today, it's approximately 12%. Look at all that prosperity. Not only did the families of the last 40 years spend all of mom's new income, but they got into debt to their eyeballs. According to the Commerce Department, a family of four, mom, dad, and two kids, are spending a lot less on market-driven goods and services, which does add to the quality of our daily lives. We are spending 34% less than they did on clothing in 1970, 14% less on food, 55% less on appliances, and 25% less on cars, plus our maintenance is down. So if the family is spending less on food, consumer goods, clothing, and even our cars, why is a family that has two income earners instead of one still loading up on debt? Remember, we just showed you the revolving debt chart. But the problem, or the perceived prosperity spread throughout our entire lives, is fueled by total household debt, the national debt, and all debt, private, business, and government. So where is the family who has been living in all this economic prosperity the last 40 years been spending their money? Let's start with all the things we have to spend money on. Health insurance has risen 85%. Mortgage payments, despite low rates, have risen 81%. Childcare, well, that's up 100% since that wasn't really an expense pre-1970. Taxes have gone up by 28% due to the two-income family. Remember, the tax rate for the second income earner starts where the first income earner left off. What we see is that where the government is involved heavily, costs have risen dramatically. The government has stretched the 7-year mortgage of the 1920s to what is now the very common 3-decade loan. FHA backs loans private lenders aren't willing to take due to the risk, and Fannie and Freddie also come in to aid anyone who can't afford to buy a home, causing an increase in demand driving home prices up and making homes inevitably less affordable. The same is true for healthcare and student loans, which we'll get to later. The single-income family earned less money in 1970, but only spent half its money on these mandatory expenses. However, the double-income family of the 2000s is spending 75% of its income on these expenses. Research done by the Brookings Institute and the authors of Freakonomics have laid out some very scary charts for today's family. They call it the family income volatility. It's pretty simple to understand. The family of 1970 had a lot of upside. They had a worker in waiting. Whether by choice or out of necessity, the family a generation ago could send an additional person to work to increase their income or provide new income if something happened to the other spouses. The family of the 2000s now needs two incomes, so the family of today has 2 times the risk as a family in 1970. They also have an increased odds that income collapses due to the double health risks and job risks. Today, both adults are already working, or as of late, collecting unemployment benefits and food stamps. Our young people today are suffering the most from this economic illusion of prosperity. In 1970, the minimum wage was $1.60 an hour. Today, it's $7.25. In 1970, a year of tuition at a public university cost $1,200. Today, that number is closer to $15,000. So in 1970, a student had to work 14 and a half hours per week in order to pay their college tuition. Today, they would have to work 39 hours a week, something that is simply impossible. Again, you can thank the government for supporting deferred loans for 18-year-olds. Imagine any business where your customer doesn't have to pay for it until they're done using it. But in the meantime, the government will give them a loan. What would you charge? A lot more than you used to. In fact, you would charge as much as you wanted because the consumer was not going to feel the cost of their behavior. It is a lot like why no one knows how much it costs to go to the doctor anymore. Why would we? We have been conditioned to not discuss price with our doctor. That's been taken over by the insurance companies, a system practically mandated by the government at the turn of the 1970s. So where does this leave us? Well, there's a lot of unraveling that needs to take place. The illusion of prosperity over the past 4 decades, well, it's time to pay for that. Learn more about the future trends we see coming at futuremoneytrends.com. Part 2 for the illusion of prosperity will be released at the end of February. Be the first to see it by signing up at futuremoneytrends.com. If you receive value from this video, please take a moment to share it with friends, family, and your favorite blogs.